In this video, we're going to talk about how you can improve on the wheel strategy by using a few different strategies that will allow you to hedge these amazing gains that you could potentially have in this bull market right now. We're going to introduce what we call the safeguard strategy that is a significant improvement on the wheel strategy. If you have been doing the traditional wheel strategy of selling a naked put on most things, especially Apple, Tesla, Nvidia, Microsoft, and so forth, almost everything over the last couple months, you have just received the premium that you received when you sold that put. So, not a significant amount of upside. If you have done covered calls, let's say you had the shares already and you sold covered calls, then you have potentially been fighting that call side if you didn't want your shares to be sold away. You have been trying to roll, but probably unsuccessfully. So I'm going to introduce two new strategies to the covered call process that will allow you to hedge the downside just in case you think this bull market is way overdone, at least for the short term, and introducing a fourth strategy that allows you to have unlimited upside for a discount. So let's break this down really quickly.
Please subscribe to our channel to commands and listening.
You can see I got Apple up here. And if you were going to sell a put on Apple, let's say at the 185 strike here, then you would receive about a little over $3, and you would have a 71% chance of winning at least some of that $3. And your cost basis would be just under 182 for Apple. So Apple would have to fall just under 182 for you before you start losing. The buying power effect, if you're using regular T margin, would be about $3,300. Now, this is a very good trade. It's a high probability trade, but if Apple goes up to 200, which is now just under 190, then you would not benefit as much. You would win your $300, but you wouldn't make the 1,100 or $1,000 that you can potentially make if Apple went up to $200, right? That's what's happening in the bull market. Everything is going up, and the good companies like Apple are going up as well, right? They've been going up for months now. So that's the traditional start point of a real strategy. Now, the second strategy is if you had to take ownership, you do a covered call, and then normally you're going to sell a covered call at the money, or maybe at a 30 delta, 23 delta, at a strike price that you think it's not going to be called away, or you're okay with it being called away, been sold away. So in this case, you would sell at the 200 strike, and then you would get that upside. As you can see, you would get $1,175 before fees and commissions. And so this is a way you can get that upside up to 200. But if it goes up more, then the most you can make is up to that 200 strike, right? So those are the limitations of a traditional type of covered call, or excuse me, wheel strategy process. We talk about in other videos on how you can improve on the wheel strategy, how you can do deep in the money covered calls. But for this video, we're going to just go over the different strategies and kind of touch on them briefly. All right, so those are the two strategies that you know of. I'm going to introduce the third now. That's called a collar strategy. When you do a collar strategy, what you're doing is you're selling a covered call like we did before at this 200 strike price, and then you're taking some of those monies, in this case about $170, and you buying a put to protect yourself to the downside. So in this example here, you can buy this 175 put, and then instead of having risk all the way to zero, your risk will stop at $1,400. Just under 14 is 1,430 here, and you can still make over $1,000 to the upside, but you're protecting yourself to the downside just in case the market decides, okay, it's way overdone to the upside, and it has a significant pullback. This is how you can protect yourself from the downside. If you think that Apple is not going to fall too much more than 180, you can roll. You can decide to sell the 195 call and buy the 180 put, and that's going to give you a 54% chance of winning still to the upside and to the downside, and your max profit is going to change dramatically to 650, but your max loss is also going to change dramatically to 850. So you can lock in some of these gains that you potentially have if you bought Apple at 175, 170, 165, 160 or lower. You can lock in some of these gains with what is called the collar strategy. A collar strategy is limiting your upside and also limiting your downside. It's bracketing off your upside potential and limiting your downside potential. This is a collar strategy. We talk about it in other videos regarding how you can improve on the wheel strategy. Now, let me introduce what we call the bionic bull. And now this strategy is taking a naked put and then use some of those monies to buy a call so you can have unlimited upside. The basics of options: if you buy a call, you theoretically have unlimited upside. And so instead of buying that call, you're going to finance it. You're going to sell a put, being okay with taking ownership of Apple, and you're going to buy the call. So for example purposes, if we sold this 185 put, it's going to give us about 105, 107 in premium, and we're going to take that and we're going to buy a call at the 200 strike. Well, if we bought this call at the 200 strike, we would have a 67% chance of winning. We would have 57 deltas. That means you'll be making 57 cents for every dollar move, at least initially. It's not static, it's dynamic, so meaning it will change. If Apple continues to go up, you will be able to make more per dollar move. You have, as you can see, unlimited potential to the upside, and the buying power effect is going to be about 30, just under $3,500, right? Yeah, you still have risk all the way to zero. None of us think Apple is going to zero anytime soon, but that's not a lot of deltas. It's not bad. You can still have unlimited upside. So if Apple goes up to 210 within this 35 days or whatever time frame that you do, you will be able to benefit from that. It's not like selling the naked put and you only benefit from the credit you receive. So if you wanted to switch it up and say you sell the put at the money, basically, which is Apple's basically trading at 190 here, just under it. So you sell the put at the 190, that's going to give you almost $500 in premium. So now you can buy the 195. So now this changes the ball game a lot. So you still got a good probability, more than a coin flipping chance of winning, but your deltas, instead of a 57, you now have an 85. So you initiate by making 85 cents for every dollar move, and that's once again dynamic. So it'll change if Apple keeps going up. Okay, it's going to change. Obviously, it will change if it goes down as well. But it's this is based on if the market continues to go up, you continue to have this bull market that we're in. Okay, so this is an amazing trade to have unlimited upside for a discount. So Apple is trading at about 190. You'll own it around 188. So you're still getting it from a discount from its current price, but you have unlimited upside, and someone's helping you finance that unlimited upside by doing what we call the bionic bull. This is one form of creating a bionic bull. We teach members of the Dorian Way several different ways how they can execute a bionic bull, several different ways how they can do a collar strategy, even having no risk to the downside at all. We teach several different ways of doing the covered call, and then also selling just the naked put. Right. So if you're interested in learning more, you can consider joining the Dorian Way. We'll put some information in the description area. We thank you for watching this video. We hope to see you in the next video. Please like and subscribe if you found value in this video. Thanks for watching.